Everyone doing? Hopefully everyone can hear me. We're now streaming. Jeff, Stacy, Dakota's in here. Lisa, Paul, Bette, Henry, how are you? Hope everyone is doing well. Hope everyone is doing better than the market is currently doing right now. Looking for some interesting opportunities. So like I said, we'll talk about that. We'll talk about where the market stands. We'll talk about some opportunities that I think are kind of interesting. Specifically, we'll dive into the pair trades a little bit deeper and I'll give you several of those. Then we can even trade a couple live. Hey, Lewis. Hey, Joy. Hi, Henry. All right, let me go ahead and share my screen and we can get rolling right along here. All right, so we are April 4th. My older sister Stacy's birthday, by the way. Happy birthday, Stacy. And we are in another mess of a market. Here is what our sectors look like for this week, which is just crazy to actually visualize because what we're seeing here is not just a dump. Obviously, I think everyone's aware of that, but we're really seeing sectors, even kind of the mid-tier sectors across the board, get absolutely hammered. And in fact, we're seeing energy lead the way. So if you guys had some of those PSX puts, that we had on the profit pair. PSX dropped almost 11% yesterday. So that profit pair hit nicely because energy got absolutely mashed for lots of reasons, macro reasons. We won't go into all of that. But energy had been the strongest sector year to date before this hit. So really interesting to see energy and technology together lead the downside. Financials also getting hammered, which has a little surprise. I mean, obviously, it's just, like I said, a rug pull, a liquidity pull, whatever you want to call it. The market's getting decimated. I was a little bit surprised to see financials get hit quite as hard, but they've gotten crushed. Communications, which was starting to rebound and do a little bit better, got crushed. By the way, a couple of those stocks have held up a little bit better than the rest of the market, like T-Mobile, I think is down like 4% today instead of 8%. So, a little better, but still getting hammered. Utilities and consumer staples holding up the best. No real surprise there to see those holding up, but still, utilities down 3%, real estate down 4%. Discretionary actually held up a little bit better, which has been leading to the negative side all year long. So that was interesting that discretionary seems like maybe it's hit its oversold level. A lot of times, one of the best ways to judge when something is actually oversold is actually on really negative days. So if something's down, 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 and then you get another push harder and it actually starts holding up better than everything else crashing, then a lot of times that gives you an indication that it's truly oversold. And so, discretionary might be oversold. Another one that might be oversold is the Mag 7. We'll see if that starts to play out. It's about even with the SPY right now. It's not leading the SPY to the downside. But let's say the next 2 days, it is... the SPY continues to take some hits and the Mag 7 evens out. That's kind of an indication that maybe the Mag 7 is a little bit oversold as well. So that's a couple things to watch. There's a few other on my list that we'll get into. But let me just take you back only a couple weeks ago to our Mapping the Market session from March 21. Was anyone here with me on March 21st during our Mapping the Market? That was a Friday, just 2 short weeks ago, if you guys can believe that. And we looked at this chart and we said the NASDAQ, this could get ugly because we had broken through kind of some recent support and we'd actually, for the first time, really even dip below this 50 moving average, which I'm not a big moving average guy, but it's a decent way to look at the ebb and flows. And we kind of dip below it as our first hint that maybe this isn't just a quick, 8 to 12% market flush, but maybe we're looking at something a little bit deeper. And so obviously my analysis here was this could get really ugly if we make a real move. Because if you see here, most times that we break through the 50, we're going to go deeper. You can see it here. You can see it here in 2022. And we started breaking through that. And I thought, this could get a little ugly. And if you fast forward now to today, it really is ugly. This is now the QQQ, which is the NASDAQ, just 2 weeks later, having not only broken this level, but bounced off it. And then obviously this week, cementing itself as an incredibly bearish kind of engulfing candle. Now, does that mean that we're going to the 200 for sure? Obviously not. There's a lot of different ways that we could see this play out. But I think it is showing you this is not just a regular market flush. We are seeing more of a kind of panic. it's not even like a recessionary move. It's more like a panic move and a fear move that we've covered so much ground so quickly, much closer to COVID than like 2022, for example. And we'll talk about that a little bit more. But this is where we stand. We're about 50% of the way between the 50 and the 200. And obviously, the question is, how much of a collapse do we get? Again, I'll talk about that on the spot here in just a moment. On March 21, we also said it's really going to be up to the Mag 7 to decide, is this a real bounce, kind of off this like 20% type of correction here to go up toward higher highs, or are we going to collapse further below the 45 level? And if you fast forward, obviously the Mag has decided. We had that little bounce. We collapsed more deeply. The mega caps have lost trillions of dollars since March 21 when we last showed that chart, and are now into like a 30% correction here on the Mag 7. Now, keep in mind, the Mag 7 could certainly have a much deeper correction than 30%. We saw, king players in the Mag 7 in 2022, like NVIDIA, Tesla, and Meta, take much deeper corrections than 30%. So we're certainly not out of the woods. I think that, we'll have some stalls and things like that, even if we go deeper, but definitely not out of the woods. And just because the Mag 7 is corrected 30% doesn't mean it's not correcting 50 or 60%. I mean, Apple is probably the one that you would look at in 2022 and say it never really got in that kind of territory. But like I said, Tesla, NVIDIA, Meta, many of those took much deeper hits than what we saw. And the FANG, obviously, most of them took extremely deep hits as well. Like, Netflix, I think, was at 75% as well. Now, I'm going to say the same thing that I've been saying over and over again. Sorry to beat a drum here, but for me, the moves here are covered calls on high volatility stocks, mechanical trades, just swinging the bat on the stuff that's mechanical, following the system. You don't know when that stuff is going to turn around. Remember, we talked about how strategies look. Strategies have pullbacks. Strategies have drawdowns. Normally, guessing when those drawdowns are going to be is a recipe for disaster. So I never recommend that. I recommend swinging the bat, trying to be as consistent as you possibly can with those strategies. And sometimes those positive runs happen when you least expect it. And then the more active thing here are these pair trades. And the pair trades, I think, are the thing that holds up best in these volatilities. Two-way options as well, which we'll talk about. Really close to our target right now on two-way options for those of you who are in two-way options. But there's just so much volatility that's going to be hard to get fills right now with 10 days still left. I know Nathan sent me an email about that. I'm not sure if Nathan's in here right now. But with 10 days left on the two-way option trade and the VIX being, in the mid-40s, it's going to be really difficult to get fills super early into the trade. But we're already near that target level. And hopefully just with a couple days of even settling markets, even if actually the market goes up a little, we should see that trade fill with a nice winner on two-way options. But profit pairs or any kind of paired trades are really the other thing that I highly recommend on the active side. So let's talk about how the pair trade works. Okay, so the pair trade works very simply by buying a call on a stock and buying a put on a stock at the same time. Now, what most people do and get wrong is that they kind of try to buy a call on a strong stock in one sector and then buy a put on a different stock in a different sector that's weak, and kind of get the home run trade where the strong stock goes up and the weak stock goes down. That's not really how I pair trade. In fact, I think that's a pretty dangerous way to pair trade because you often have reversion to the mean where you lose on both sides. So what I try to do is I try to find sectors that are trending where everything's kind of going in the same direction. So you have, energy that's going down, for example, or you have, some staples that are going up, for example. And instead of trading things that are going the opposite direction, you just trade a call on one that's a little bit stronger and then a put on one that's a little bit slower. So you're not trading totally different directions in most cases. You're simply getting a stronger out of the same net movement. And what you want to happen, this is where it actually matters, is you want to set yourself up for a position where one side can easily get over 100%. Why? Because if one side can easily get over 100%, it means you can't lose on the trade, assuming you have about the same amount invested in each. Okay, so how do we do that? Well, there's a couple rules here. So the first rule is sector, or you can more generally call this correlated. You want two stocks that are correlated. Okay, so again, if you're trading a healthcare stock and an energy stock because one's strong and one's weak, and then they flip, you're going to lose on both sides. What we want is two health stocks or two energy stocks or two staple stocks where one is just performing a little bit better and can outperform the other. But even if that doesn't happen, you're still in a position to make money. Okay. Think about it like this. I'm going to give you Walmart versus Target, right? So let's say Walmart and Target both bounce back dramatically next week. You have calls on Walmart, you have puts on Target. But let's say Target bounces back further. So Target's actually up 12% next week. Walmart's up 7%. Well, you're still going to make money even though you picked the wrong one because the move was enough to get them both into triple digit figures. You lose on Target, but you make more on Walmart, so you're still going to make money. Compare that to if you get it backwards and you go, short energy because it's weak right now, and then you go long something super defensive that's up, like O'Reilly or something like that, and then they flip. Now you're going to lose on both sides. That's the situation we want to avoid. So we want stocks that are in the same sector or at least correlated. Like a lot of times I use the indexes or things like that. Okay. Number two, to make this work, is you want to have out of the money options. Okay. You want OTM. Why? Because again, we're trading the volatility, big moves. We want to give the option the easiest chance to get over that triple digit gain so that you can't lose on the pair. The best way to do that is to trade OTM. Think about it once again like this. You have Walmart, you have Target. Let's say the market moves crazy and they're plus 10% next week. Rebounds like crazy. Let's say the market continues to crash and they're minus 10%. The losing one, the one that you have calls on that's down, or the one that you have puts on that's up, it's not really going to matter much if it's at the money or slightly in the money if you get a big move, right? It's still going to be getting its teeth knocked in. It's going to basically be down 99% either way. Maybe the difference is it's going to be down 96% versus down 99%. So really what you want to capitalize is the one that's winning. And the best way to do that is to do out of the money options so you give it a better chance of getting into the triple digit gains, right? Because if Walmart is up 10% on the stock, the out of the money option could be up 200%, 300%. If you did a deep safe in the money option, now it's going to be up 80% and your other option is going to be down 90% and you're not going to make any money even though you got a 10% move. Simply using out of the money options is how you solve that, giving it an easier path to get those big moves. Now it's riskier if the market doesn't move at all, but we are expecting the market to move, and so we're using those out of the money options. The third thing is time, okay? Or think of this as days till expiration on the option. We want to have a middle ground where we give it enough time to make a nice move. So let's say that Monday is kind of a dead day, just a capitulation day, doesn't move much. Tuesday's kind of a quiet day, and then halfway through the week we get ripping news and it moves up. Well, you don't want it to be out of time by the time you get that move, but you also don't want to give it so much time that the value doesn't move quickly. Okay, so the way that I do this on really high volatility trades, I'll give it about 2 weeks. Okay, so 2 weeks, maybe 10 days sometimes, something like that. And on longer term, kind of like more traditional system trades, I'll give it about 6 to 8 weeks. Okay, with the market crazy volatile right now, we're going to shift toward the shorter side of the equation. We're going to give it less time because we expect either the market's going to keep collapsing or we're going to get some big rebound moves. And so the smaller time frame is going to give us a bigger payout for that move. Okay, so get them correlated, use out of the money options, shrink down that time frame a little bit without going so shortly that you run out of time with no move. And that's kind of the combination of how we want to use a profit pair. And again, the use case for this, I'll just use one of the ones I'm about to give you, which is Walmart versus Target. Okay. And the situation that we're trying to play here is that if both of them go up, we're going to win because we're going to make money on a Walmart call. And if both of them go down, we're going to win because we're going to make money on a target put. And that's really the situation where we're basically saying, hey, listen, if they grind and go nowhere, that's where we're going to lose money. But we're playing into the volatility. We're expecting either the market's going to move up, have a big rebound, or it's going to continue cratering. And either of those scenarios pay us off on a pair trade, just like PSX earlier this week paid us off. Okay, does that make sense to everyone? Does the basic concept of what we're doing on the pair make sense for everyone? Kind of setting that up, the fact that we need to give it enough, uh, bang for the buck that it can easily get over that 100% gain, and therefore the pair is guaranteed to make money. All good? Give me a yes in the chat if you're following along here. And then what we'll do is we will move on to the couple of pair trades that I recommend, and then we can even set them up live. Like I said, I already have some cash out on these, so I'll just do like one or two contracts on each. I'm not going to go crazy here, but that way you can actually see it executed live. All right, here are the ones we're going to look at. I actually gave you this bonus one here that I talked about before, which is the IBIT versus BITO. But we've got MAGS calls versus SPY puts. This is MAG 7 calls versus S&P 500 puts. The idea being here, if the market's going to collapse, I'm sure MAG 7 will collapse as well. And these are going to lose, but the SPY puts are going to make a whole bunch of money. If the market has a big rebound, I think the MAG 7 has the potential to rebound more aggressively, and so will outperform on the call side, and the SPY puts will be down. Okay, so we're expecting either way, one side of this trade is going to lose. Okay, that's what we're not expecting to win on both sides. We're expecting one side to lose, but put ourselves in a position where we can create an outside gain. Oh, that's the first one. Next up, we have XOM calls versus COP puts. This is an energy play. XOM to me looks the best, but I expect one side to lose and one side to win. Next, we have Walmart versus Target. Target's actually up a little today. Walmart's down. I think that's going to get, kind of rebalanced, but I still expect one side to win, one side to lose. If this retail gets smashed, I expect Target puts to win. If we get a nice rebound, I expect Walmart calls to win. All right. And then we have this one, which is kind of an interesting one, which is literally just Bitcoin versus Bitcoin, but IBIT and BITO perform a little bit differently. And I think that you can get a little extra bang for your buck by trading the stronger Bitcoin asset. But this is more like a straight up strangle in a way, because we're really trading Bitcoin on both of these positions. Okay. So does this make sense? We're gonna go in. I'll show you each one of these, but we're gonna trade them at the same time, looking and assuming one side's going to win, one side's going to lose, as long as we continue to get some big moves in the market. Okay, before we jump into the charts and take those trades on, a couple reminders here. For all my members, just a reminder, you can now email me directly. I sent out an update earlier this week with an email directly for me, so that if you have questions, you have comments, you have concerns, you can just send me a direct email to my Gmail, and I'll be able to respond to you. You don't have to go through support. If you don't want to, you can just email me directly. If you didn't get that update or you need my email, just email support. Say, hey, I want Nate's email. As long as you're a member, they will send you that email. And that way, from here on, you can email me directly. Again, if you have questions, concerns, whatever. Thanks to all of you who have sent me some emails so far. I saw a couple of you already in here. Hopefully that's been helpful to be able to get a hold of me directly. But that's just a reminder that you are able now to do that. And go ahead and email me, anytime you have questions, concerns, things like that. Okay, next thing, make sure you're in my Telegram. I think most of you are in my Telegram. Dakota just popped that in there. Thank you, Dakota. That's where I'm sending updates. That's where I'm kind of saying, real-time analysis. Hey, we're getting a shakeout here. Here's what I expect. All that's happening in Telegram. I normally post in there 5 to 10 times a day. Make sure you're in there. And then lastly, just make sure you're on my text list for stock of the day. Obviously, the stocks that I'm giving you right now are going to be longer term holds because the market's in chaos. So, when I'm talking about some of these trades like Exxon and things like that, they're down 10% in 2 days. Obviously, those are going to be longer term, but every once in a while, I'll give you a shorter term trade as well in the stock of the day every day via text. Kurt asked about the two-way trade. Nancy, so that's the SMS list. All you do is sign up. I'll send you a text every day directly to that list, right to your phone number. Dakota, do you mind grabbing that link as well? Actually, I think I have it here. Yeah, I do. Okay. So if you want to get on the text list, there you go. I just popped a link in there. You just literally put your phone number in the box, and I will send you a daily text with a stock that I like. Again, lately, they're going to be mostly longer term stocks because of where the market's at. But occasionally, I'll give you some shorter term moves as well. Just my kind of the stock that I'm watching, the one that's at the top of my watch list. You'll get that every day just from being in there. Okay, we're going to go in and take a couple pair trades. But first, let me just quickly walk you through where we're at on the SPY. Okay, real quick here. So this is the SPY on the weekly chart. I was hopeful that we were going to hold up at a nice 10% correction. We did not, obviously. We are now looking at a deeper correction. The question to me is, are we going to get all the way back to the January 2022 level, which would be a 25% correction? If we get into the 25% correction level, that's basically where I'm going to deploy the rest of my cash into the market. Just to be fully transparent with you, I've been holding some cash on the sidelines for quite a while. If we get into this level, into this 25% correction, I'll be all in. I'll deploy the rest of my capital, probably between a mix of the SPY, the Mag 7, and then some stacking positions on specific tickers like Apple and ones like that. We're still a ways away from that. So I think there's only maybe a 50-50 chance that we get down to a 25% correction. But that's kind of the key, big boy level at around 460 on the SPY that I would watch for to kind of say, hey, this is as deep of a flush as I can sit back and watch before I think it's just too much of a buying opportunity to deploy basically the last amount of cash that I would have into the stock market. So 460 is the number that I would write down on SPY. Obviously, a key level, represents really the top before our last flush. A coin flip for me, if we get here, is kind of how I define this. Now, I want to talk about the COVID drop because I think that most closely mirrors what we're seeing now. I don't think what we're seeing now is anything like a 2022 bear market. I don't even think it's really a 2008 market. I think it most closely represents the COVID market. So let me go ahead and zoom in here real quickly to what we're seeing right now. Two of the biggest back-to-back negative days we've had in the last decade. The SPY has a chance to move more than 5% in 2 consecutive days right now. We're at about 16.5% right now. Someone just asked how far are we down right now on the SPY. Right about 16 to 17%, depending on where today finishes, down from the peaks on the S&P 500. We've had these massive gaps here, right? And I think the crazy thing about what we're seeing right now is that the market did such a poor job of pricing this in. Because, obviously tariffs, like no one was shocked that we had tariff news, right? Tariff news has been hitting since the inauguration. It's continued to hit. Then we forecasted exactly what we were going to do. And we were apparently totally unprepared for that, which is pretty shocking. And the market has catapulted down the last couple of days. Now, to me, we're already at the overcorrection state. Now, I'm actually bullish on tariffs long term. I'm in the minority. I still think the tariffs are going to be a net positive. They might not be a net positive for the stock market, but for the economy, I'm actually net bullish on tariffs in the long term, fast forward 2 years from now. So I already think that we've overcorrected, but just keep in mind that an overcorrection does not mean that the market's going to start going back up. What I want to do is show you what actually happened during COVID. Okay, so we got to go all the way back to 2020 here to look at what happened at COVID. Remember, COVID was actually kind of similar. Okay, so we were back here in February, and everyone was already talking about COVID. How many of you guys remember? I mean, it's hard to go back 5 years, but keep in mind, we were talking about COVID before this happened. It wasn't on the front page of every paper like it would be for the next 6 months, but we were talking about the Chinese lockdowns. We were talking about if it was going to come to America. We were talking about how it could affect supply lines. We were talking about all of that kind of stuff before the real collapse happened. Then it hit mainstream, cases started going up, and we started seeing these massive moves, okay? Huge move here, next couple of days, huge move here. And then right about here, when we were only at, about a 10% correction, things started rebounding pretty dramatically, okay? So this was COVID. Things started rebounding pretty dramatically at only about a 10% correction. But what happened after that? The market said, oh, we're not nearly done with this. More cases, more trauma, more supply lines, boom, boom, boom. And we hit the bottom of the market here before we went into April. So the bottom here was the 23rd of March before we had a rally for the absolute ages. And in total, we went down right about 30% from the highs all the way down to the March 23rd low. And I think what we're seeing, I don't think we're going to get a 30% correction necessarily, but I think that's kind of what we're seeing. It should be better priced in. We should be prepared for it. The market has even shown a couple signs of trying to rebound, and then we've got boom, boom, boom. Like for example, here on March 5th, after we'd actually made a nice rebound, we moved down about 4% on March 6th. Then we moved down about 8% over the weekend. Okay. Then we actually went about sideways for 2 days. Okay. This was March 11th. Then on March 12th, we moved down another 10%. And this is kind of the type of market trauma that I think we're seeing, where liquidity is going to be very patient to move in here. But aside from that, there's so much fear. There's so much liquidity from the retail side and from people kind of hedging, or maybe even still taking some profits from the people who were early on NVIDIA and things like that, that we're just not out of the woods. It's hard to predict when the market is going to stabilize because even if it's overpriced, even if we are overcorrected, it doesn't really matter if there's continued yanks of liquidity simply because of fear. So we could see the bottom today. Today could be the bottom. Today could be the low. Or we could see something that lasts about 20 or 30 more days. What I don't really expect is something that lasts the rest of the year. That's my expectation right now. To me, this is more of a panic, kind of a one-off news reaction than a recession sentiment reaction. And so I would expect, whether it's a week, 2 weeks, 6 weeks, maybe 10 weeks, let's say, I would expect us to find a bottom and then build back from there versus to see a new recessionary trend. And I think if we continue to get the kind of action like we have right now and like we saw in COVID, that will be the confirmation of that. What I really don't want to see is, I don't want to see the market grinding lower. I actually rather have the 5% down days than I would grinding lower. And so I'm hoping, hey, a couple more flushes, a couple more 3% days, or 2.5%, 4% days, whatever it ends up being, and then we find a bottom and we move up. And that's kind of what I'm expecting. But that 25% correction level, let me just go back to the weekly chart here. That 25% correction level that I have marked here around 460 is the one that I would most heavily watch as kind of the big boy level, where I would essentially deploy all the cash back into the market, thinking, yeah, it might go to 30%. It might even go to 33%, but my downside is limited and my upside is maximized by the time we get around that 25% correction level. So that's the one that I would watch. All right. With that being said, let's go ahead and get into the actual pair trades that I mentioned. I'll move this down and I'll go ahead and open our brokerage so that we can go into those trades. Let me go ahead and go here. There we go. By the way, someone asked about the two-way trade. This is the two-way trade that we have right now. It's in great shape, but the market's not going to show you how good it is simply because of the spreads, the bid and ask. Who asked me about the two-way trade? Kurt. Okay. So the two-way trade is this one. So the bid and ask is gonna bounce around like crazy here. Let me just zoom in on the P&L and I'll show you what's actually happening here. Okay, can you see the let me just zoom in. Can you see the P&L now, Kurt? Let me know. Okay. So this is going to bounce around. It's going to go up 10%, up 20%, then it's going to go down 5% or down 8%. And it's going to be crazy because the bid and the ask are so wide right now because the VIX is at 40. Okay. The reason that's happening, the reason this is crazy is because it's showing this trade here because of that of the spread down 194% on a piece of the spread. In reality, this trade can't be down 194%. It can only lose 100%. It's just that the spreads are so wide that based on where the market, mark is, it thinks, Thinkorswim doesn't know that the trade can only lose 100%. It's just going by the price flow. It thinks you're down 194% on the trade, even though the most we can lose and what we will lose on this side of the leg is 100%. Well, as soon as you change that from negative 194% to down 100%, the trade looks great. And it is great because we're now 30 points below our key level. So this is a trade that looks absolutely ideal. We're 30 points below our leg. Just so everyone who's not a two-way option member knows, we want to lose 100% on this trade. That's what we want to happen. Why? Because it's a spread where if we get above our line in the sand or below our line in the sand, one side is going to lose 100%. So we actually want this to lose 100%, and it will lose 100%. It's just right now, the VIX is so crazy, the volatility is so crazy, Thinkorswim literally doesn't know how to calculate that, or any brokerage, because all it can see is the volume fed in. So this is a trade that looks absolutely perfect, and Kurt, I 100% expect it to fill as soon as we're able to get just a reasonable calmness in the volatility. We should see this one look really good. But of course, right now, it's going to be crazy because of the spreads, the bid and the ask being so wide. So hopefully that makes sense. You can already see it bouncing back and forth between down 2% and up 15%. And it's going to keep doing that until we chill. So I just wanted to show you that real quick because I got some questions on that. Okay, now let me zoom out here and we can go through our pair trades real quick. I've already been going about 35 minutes, a little bit longer than I was anticipating, but bear with me and we'll jump into our pair trades. All right, first trade. Let me just go ahead and pump these in the chat, by the way, so you guys can follow along. First trade is going to be our MAG 7 calls versus our SPY puts. Okay, now remember, we're going to use, 2 weeks or so out, 15 days or so out. We're going to use a little bit out of the money, and then we're going to use a correlated asset, in this case, MAG 7, which is, of course, correlated with the broad market because it's the most heavily weighted in the broad market. The first trade we're going to do here is the MAG 7. Okay, how do we do it? We go first to our ticker, MAGS. By the way, gold, GLD versus SLV, that's a bonus one. You can put that one on too. Okay, so on the MAGs, we're going to go with this 2 Fridays expiration on April 17. Okay, so April 17, that's a Thursday. I guess the market, we have Good Friday on the 18th? Yeah. So the April 17th is going to be our expiration, which is a Thursday, not a Friday. But we'll throw that in on the call side. Okay, now what call are we going to take on the MAGs? We're just going to basically go a couple percent out of the money. All right, in this case, it would be the 43 calls. Okay, so like I said, I'm not going to go crazy here. I'm just going to do like 1 or 2 contracts, show you how they actually get executed. I already have some of these in my other account. I don't want to go too nuts here, but I just want to show you how each one works and then how to actually balance them out. Now, one of the things we're going to have to do here is probably take a couple extra contracts on the MAG 7 in order to get them balanced for the actual money at play. What do I mean? I mean, if you buy a put for $500 and you buy a call for $200 and the call is up 100% and the put's down 100%, well, it should be breaking even, but now you've lost money because you don't have the same amount of money invested in each. Okay, so we want to actually balance out the amount of money in each, right? So let's go ahead, before we actually put the MAG 7 trade on, let's go ahead and look at the SPY. And then we'll get an idea, because the SPY is going to be more expensive, how much we want. Again, we're going to go out here to the same expiration, so the April 17th expiration here. All right, and you can see if we go down about 2 or 2.5% even on the SPY, we're going to go, let me add a couple more strikes here. We're going to end up paying here. Let me add a couple. There we go. We're going to end up going right around the $500 puts. We're going to end up paying right around 11 bucks for that SPY put. Okay, so that's obviously going to be a lot more expensive than the much less expensive Mag 7 put, right? And we want to balance this trade out. So for one contract on the SPY right now, with the volatility as insane as it is, you're going to pay about 1,100 bucks. Fairly expensive for a SPY put. Again, the VIX is 40, so you got to expect that you're going to pay a little bit more. But we would have to accept paying right around 11 bucks for this SPY put. So let me go ahead. I'll get this one in because it's the more expensive one. Let's see if I can get filled here, maybe a little bit cheaper, right around 11.35. Again, this would be the SPY. Okay, let me go ahead and type it in here. The SPY, $500 put at, I'll try to get filled right around 11.30 here. Okay, so that would be the first leg. Let's go ahead and see if I can get, I'm just going to do one contract for now, 1,100 bucks, see if I can get filled. Let that sit there for just a minute, see if it gets filled. If not, we can move it. SPY bouncing right around negative 4.5%, 4.6% here. See if it jumps a couple pennies, that would help me get filled. All right. Whoop, whoop. Let's cancel and replace and try again. SPY's going down again, as it's been liking to do. All right, let me try 11.35, see if I can get filled. All right, that filled. Okay, so it filled at 11.35. So now I have $1,135 invested in the SPY put. So I want to match that on the Mag 7 call so that I have an equal distribution, okay? I'm going to go to a similar out of the money. I want a little over 2%. So if I go to 43 on the Mag 7, I'm going to be similarly priced on the call, a little over 2%. Now, again, this is priced at about 175. So I'm going to need about 9 contracts or so. Actually, we should be able to get a better price. The spread is, now you can see why other trades aren't getting filled. The spread is like 60% on the Mag 7 right now. So let me go to 10 and see if I can get filled in this 110 range. I have no idea if this is going to fill or not. Someone asked how am I doing percentage out of the money? I'm just calculating it in my head. So if the mag is at 42 bucks right now, then I know, if it's $1 higher, it's a little over 2% out of the money. And I kind of want to match that on each. It's showing the mark like 1.4. It's gonna be tough to know exactly what we can get filled out here without just being really patient. So let me go. I'm just gonna have to be a little bit patient with everyone here. And just kind of move this up pennies at a time. See if we get filled here. So TJ asked if you can do this with debit spreads to make it a little cheaper. TJ, you definitely can do it with debit spreads. The only challenge with debit spreads is if you go out of the money on the debit spread, then you are going to increase the risk of losing on both sides. Versus on the straight call and put, as long as they're moving, you should be in pretty decent shape. So you raise the risk of losing on both sides a little bit, but of course you can trade it cheaper. And depending on how far out of the money you go, you can actually get some really nice risk rewards as well. All right, so $43 call is what we're doing on the Mag 7 here. And I'm trying to get filled right around 112, but I don't think it's going to fill yet. The spreads are crazy. So I'm buying a call on the Mag 7. I'm buying a put on the SPY. The idea being if the market goes up, hopefully the Mag 7 will get some big gains on the call. If the market continues to collapse, hopefully the SPY will pay some really nice gains on the short side. Mag 7 is actually going down a hair right now, so it should be making this easier to fill, but the spread is just gigantic right now. So I'm just going to have to kind of inch it up, inch it up. I mean, this takes a little bit of patience. See if I get fill. I'm just going to inch it up. I'm not going to go all the way to the mid price. I'm just going to inch it up and see if we get a fill. With spreads this wide, I just start at the bottom end. I just inch my way up until I get filled. I don't automatically pay the mark that the market's asking me. Sometimes I have to go up and pay what it's asking, but I start, start near the bottom end, move it up. 44 is over 4% out of the money. So you could do that. And if you hit, it'll hit even bigger, JP asked. But I try to keep it even. So since I'm playing the SPY about 2% out of the money, I'm playing the Mag 7 in a similar neighborhood in terms of out of the money. All right. By the way, I threw that back in the chat, but we're not filled on the Mag 7 trade. We need to wait and see. See if we get a fill here. It's funny, you can see how crazy the market is right now because the Mag 7 is actually going down right now, and the mark on the spread on the calls is actually going up, which just shows you how wacky this market is with the VIX up 37% today. Not exactly surprising, but just wild to see in action. All right, we're just inching up here, folks. We're just inching, trying to get filled on a pair trade. I'm committed to getting filled because I obviously have the SPY side in there filled. So I need to get the other side filled. Just kind of inching our way up. Here's the SPY filled right there. All right, up about 5%. There you go. The nice thing, sometimes with pair trades, you get filled and it'll jump up and profit, and then you get filled on the other side and you have a little head start on the trade, which is always fun, but that requires you to actually get filled on the other side at some point, which right now we're not getting filled quite yet. We're probably going to end up having to pay 140 or so, I'm guessing, for the Mag 7. I mean, $1 is way too cheap, frankly, just for the implied volatility of the Mag, but I was hoping we could sneak into it for a little better. So we'll see here. All right, let's inch our way up here. I'll go up to 130. Oh, no, data contract. There we go. Eight contracts. Eight contracts at 130. We'll see. By the way, how about coin today? I'm still holding coin. I have those covered calls, which are juicy, but the stock itself has just been plummeting. It's down 7% today on a day where Bitcoin's currently up 2.6%. So if that doesn't show you what kind of liquidity crunch this is, where coin is down 7% on a day that Bitcoin is up 2.5%, I don't know what else you can say. It's just a full crunch across the board. And there are some reasons that certain sectors are getting hit harder and all that kind of stuff. But frankly, I think it's a lot less about correlated macro impact and a lot more just about the liquidity. Babette, the two-way trade is already going to be up quite a bit because we're about 30 points below our line in the sand. So I highly doubt that you get filled for a decent price. But if you can get filled for a decent price just because the volatility is so crazy, by all means, you could take it. I just wouldn't pay, 90 cents for it because that's what we're trying to get out of the trade for. You know what I mean? All right, let's work our way up on this. Sorry, guys. Normally, you have to crawl your trade up a little bit, but this is taking a little bit longer because the market is obviously insane. All right, I'm going to try quick at 135, see if I get filled. Probably going to have to go up into the 140s here. I mean, the implied volatility here, 67, actually not that crazy. It's only implying a $4 move. It's actually not that crazy to imply a $4 move, considering it's down, another $2 today. Okay. Going up to 140. Do I need to go down? Let's see. Yeah, I'll keep it at 8 contracts there. I tell people about using pair trades and how you have to creep up your orders, but this is extreme. We're really taking our good old time getting filled. I'll leave it at 140 here for a minute, see if we get filled. The good news is the SPY is going in the right direction. So it's not like we're waiting to get filled where we're losing money on the other side. That's kind of what you want to avoid. You want to avoid waiting to get filled on the other side when you're losing money, because then you have the opposite of a head start. You have a negative head start. Here, we're moving in the right direction, so we're just getting a little cushion on the SPY right now as it moves. So I don't mind being more patient with the Mag 7, but I'd like it to fill here. See if that mark moves back down and fills around 140. Patient, patient, patient. I'll give it about 10 more seconds before I bump it on up again. Let me update my trade because we certainly are not going to get filled at 120. That's obvious. All right. Beat me into submission. Let's go to 143. Come on, be nice. Move a little, Mark. Mags are down another couple pennies. Come on. Move for me, Mag. Here's what it looks like. Here's what it looks like on the chart. It's an ugly one. Woo! Look at that chart. Talk about an ugly move. Down about 30% from the highs on the mega caps. But if you look, I mean, we've moved down just in the last couple of minutes. Still hasn't filled. All right, 145 we go. Let's see. Oh, filled instantly. All right, 145 it is. So there's the actual trade that we took just forever to get into. 145. All right, moving right along. Next trade is XOM. Okay. We're buying here, Joyce. We're buying calls, buying puts. Okay, so XOM, this is our long side. We're going to look at calls again, a little bit out of the money. We moved about 6% today. So we're going to look at these calls that are probably 107, 108. Probably the number. Those are in the 290 range. Okay, let's go ahead and take a look at COP, see what the puts are going for. Probably a little more expensive if I had to guess relative to price. Not bad, though. Not horrible. Go down to the 85, about 380. Go down to the 8250. Yeah, we could trade these about the same price. Okay, let's do that. So let's go ahead. I'll see if I can get filled here for about 295. So this is going to be the, here, I'll just type it in here. This is the COP, April 17, 8250 put. And we're going to try to get in here around 290, 295. It's bouncing just a hair. See what that looks like. 295 there. That's on the put side. At the same time, I'll jump over to Exxon and we'll trade the 108s here for right about the same price, a little bit cheaper. Okay, so these ones are nice when they're a similar price. You could just match up, even contracts, one contract to one contract, two contracts to two contracts, and make it a little bit easier on yourself. That's the 108 call. And we're about 285 on that one. See if that gets filled there. All right, filled easily on Exxon, but COP did not. Let's go up here to $3. See if that gets filled. Yep, two separate trades, two totally separate trades. Can't do it on one ticket, unfortunately. So it's just two separate trades. Put them in. COP is still floating a little bit above $3 here. See what it's doing on the actual chart after the mash today. Whoo. Yeah, so it's literally still going down, which means those puts are going to be a bit harder to get filled in. If it pops 10 cents, we'll get filled. So I'll give it just a second here, and then I'll move my limit if not. VIX now 42, folks. 42 on the VIX. Whew. We are cooking. Check out, I mean, speaking of big charts, check out this bad boy. This is the VIX. Look at this. Crazy. Probably more where that came from if I had to guess. Mike said my personal VIX. Oh, there we go. Filled on cop. All right. There we go. So I ended up paying three. Let me update that. I ended up paying $3. Close enough that I'm, just going to match them one-to-one contract. There you go. Those are our two energy trades there. Notice that the Mag 7 says we're up 48%. Not really. It's just the volatility playing tricks on us. But that's fine. All right. Next trade, we're going to do Walmart and Target. Okay. Now, I'm going to give this one a little more time, folks. I'm going to give this one this 28 days. So this is May 2nd. I think that Walmart's probably a better stock in the next month than necessarily in the next week. So I'm just going to give it a little more time. But a similar idea, 84. We get 2 or 3% out of the money here with something in the $86 range on the calls. That's about 2.5%, 3% out of the money. Okay. It's going to cost us $2.70 to $3. Then I just flip over and I look at Target. How much are the puts going to cost us for the same date? Go a couple bucks lower here. 370, 375. We'd have to go all the way down to the 90s to get us much cheaper than that. At 93. So Walmart here. Let's see, where's the accent? Yeah, we'll probably go 86s here. 86 puts us about 2.5%, 2.3% out of the money. It's a little aggressive, but obviously we're playing into the massive volatility. So we'll do that. But remember, this is on a little bit longer time frame. So this is on the May 2 calls. And that's at the $86 level. And we should be able to get into there about 280. All right. Now we're going to have to even this one out a little bit because we're going to have basically a $2.80 versus a $3. So we have to have, 3 in one and 4 in the other. But let's just get filled first. Oh, filled instantly for 280 on the Walmart side. All right, then let's jump into Target here. We'll grab these. Let's see, how much are the 91s? Still too much. All right, we're going to go to the 92s. Okay, so we're going to go to the 92s here on Target. Same expiration date on these trades. Always do the same with each pair. All right. And we're going to have about 380 there on that one. Okay, so if you want to match these up, what you do, because you want to have the same amount of risk, you're going to have, basically two Target puts, 3 Walmart calls. It's going to get you back to, in the neighborhood, close enough to be balanced, right? What would that be? Let's check. 280 times 3 be about 840. 380 times 2 is going to be a little less, about 760. So you're fairly close there if you have 2 Target puts for every for every 3 Walmart calls. All right, so we'll do 2 here. And then we'll just go ahead and we'll add a couple of these Walmarts. Add 2. Walmart has nice volume filling instantly. Target taking a minute. See if it bounces down to 380. I'll just give it just a second there. Okay, I'm gonna have to pay a little more here. Let's go up to 385 on the target ones. There we go. That filled immediately. All right. So now we have those three. And now the last one I mentioned is this one that I have open here with a small position. That's the IBIT versus BITO. Okay, the idea here with the IBIT and BITO is that BITO and IBIT are both Bitcoin tickers, but BITO performs weaker in most cases. So even if the market goes sideways with Bitcoin, typically BITO is actually going to fall because it's just not a good asset and it underperforms, while IBIT should track appropriately. At the same time, if Bitcoin takes a big run up, BITO will lag behind while IBIT will perform correctly. And so you get a little margin built in on the IBIT versus BITO trade just organically from the way that they function. It's a sneaky little trade that you can add right there. So those are the four pair trades that I have open right now. Actually, I have more than that, but just the four that I just did. I think they're all interesting. What we really want to see is movement in the market, which I think over the next couple of weeks we certainly are expecting that kind of movement. And this gives you kind of a hedge in both directions while also having a correlated asset, so that if you get the big move in health, or you get the big move in energy, or you get the big move in the broad market, you have things that are going to move together where your calls and puts can outperform each other based on which direction that it's going. Elisa, I did two Target puts, three Walmart calls, so that I have a similar amount of risk at the same time. Bitcoin is BITO. Right now, I have a little bit longer term ones on here, so I have it out to the May 16th, and I have a little bit more in the money here. The reason for this is because I want to kind of hedge that situation of BITO and IBIT performing fundamentally different. And so I want to take a little bit of the implied volatility out of this trade. And so I have the 18 puts on BITO and the 46 calls on IBIT. And then for me, how do I get out of the trade? This is just a discretionary situation for me. So I don't look to try to get the maximum profit out of these. Basically, if I get one big outsized move where a trade's up 150% or 180% on one side, I'll go ahead and shut it down. Or if it's kind of grinding higher and higher, I'll leave it alone. So if I'm getting a slow move, I'll wait. If I'm getting a really fast move, I'll pull the plug and take the profit. But anytime you get one side over 100%, normally a good opportunity to go ahead and take some profit. Maybe take one of the contracts if you have more, take a couple of the contracts, and let the thing ride. By the way, I think the SPY just made new lows, I believe. Yep. Just made all new lows. Can't zoom in enough. 507, there we go. So this weekend is going to tell us something. It's going to tell us if some institutional money starts to move in. Remember, I'll keep reminding you, the big thing that I want to wait and see is if we get some insider buying stepping in and deciding that there's enough of a floor here. So far, it really has not picked up, even in spite of this crazy flush. So that makes me nervous, makes me think that there's still definitely room to the downside. So got to be careful, obviously. Something that I think that we have to, be mindful of, trying to trade actively, be consistent, all that kind of stuff. But at the same time, using these kind of things like covered calls and pair trades that give you some buffer if things continue to go down. Because remember, as ugly as this market looks, it's down 16%. That's bad, but we've seen the market go down 30%, 40%, and 50%. So you got to leave enough room, kind of enough dry powder there to kind of hang around. Tom, for when I trade the pair trades, like I was saying, if I get a big outsized move, I'll just close it immediately. Or if it's kind of grinding a little bit slower, I'll wait and move it then. What I typically want to see is anything from a 25 to 50% net gain. So if one trade's up 150% and one's essentially down 100%, which is usually what happens with the big move, I'll take it, right? Because that's a nice net gain. If one's up 300%, then I'm definitely going to take it. If we get that big outsized move. Yes, our overnight option trade from yesterday got absolutely destroyed today. Like I was saying in Telegram earlier, we were doing a pretty decent job of dancing between the raindrops. Obviously, I was kind of buckling before I put that trade out yesterday, thinking, ugh, do I really want to put the trade in? But trying to follow the rules, be consistent, and if the market floated up a little bit after a crazy outlier move, I would have been happy that we put it on. Obviously, not the case. More of a double down and a big ugly move today. Yeah, exactly. So if we get a big move, then we'll look to take the profit on any of these pair trades. And usually that'll happen early in the trade where you have enough time value. You can just say, okay, I'll cut it. But if it's just kind of grinding and trending, then I normally hold it a little bit longer. All right, folks. Well, I hope everyone has a great weekend. I don't know about you. I'm happy to see this week come to a close. I hope next week looks a little bit different for sure. But we'll see what we get. I think right now we're kind of right in that this could go either way environment. So I think I think we can see that. For those of you asking about the two-way options, I think we're going to go ahead and stream that. We got a whole bunch of questions today asking about the two-way options, which obviously makes a lot of sense to be talking about right now because of what the market's doing. We'll go ahead and play that two-way options presentation for anyone who wants to stick around and watch that. I said in that presentation, I'll say it again. With this kind of volatility, can't really recommend anything higher than being, in position for a move in either direction. Our current two-way trade is looking phenomenal. Probably won't close immediately because the spread's so crazy, but we'll continue to look at all those opportunities on those two-way trades because it's just such a good strategy for when the market's going crazy. And I don't expect that to end anytime soon. So hang tight if you want to watch that presentation. We'll play it right here in the Zoom room. You don't have to go anywhere. Just sit here. We'll get that queued up. But otherwise, wish everyone a great weekend, and hopefully we'll have some good opportunities over the next coming weeks and bang out some two-way winners and some profit pair winners along the way as well. All right, let's go ahead and play that two-way presentation for anyone who wants to stick around and